Today I'm going to share something with you that nobody taught you in school and that could change your financial life forever. Ever wondered why keeping your money in the bank isn't the best option? Stick around till the end because I'm going to reveal the reasons why you shouldn't keep your money in the bank. We've all been told that keeping our money in the bank is safe, right? The main reason is the sense of security that banks provide us. They give you a savings account, a debit card, and assure you that your money is protected. Sounds good, doesn't it? But it's not true. Here's the catch. That sense of security is a carefully crafted illusion. However, the reality is that most banks pay extremely low interest rates, like measly 0.01% or even less. In other words, if you have $1,000 in the bank for a year, you'll only earn a few cents. The worst part is that while your money is in the bank, the same banks use your funds to make investments and loans at significantly higher interest rates. This means they're making considerable profits using your money, and what do you get in return? A minuscule fraction of those profits, if anything at all. So where does the difference between what banks earn and what they give you go? Straight into the bank's pockets. This difference between what banks earn and what they pay you is called the interest margin, and that's how banks make their profits. Think about it. Why settle for earning just a few cents a year when you could be making your money work much harder for you elsewhere? That's where the concept of compound interest comes in. Did you know your money can work for you? Imagine investing your money wisely and watching it grow on its own without you having to do much. That's compound interest, and it's the key to accumulating wealth. Compound interest is like a snowball rolling downhill and getting bigger and bigger. The longer you let it roll, the bigger it gets. So how does this work in the real world? Suppose you have $1,000 to invest and decide to put it into an investment fund offering 10% interest per year. In the first year, you'll earn $100 in interest, so at the end of the year, you'll have a total of $1,100. Here's where it gets interesting. In the second year, not only will you earn another $100 in interest on the original $1,000, but you'll also earn an additional $10 in interest on the $100 you earned in the first year. This means that at the end of the second year, you'll have a total of $1,210. The true magic of compound interest is revealed when you look into the future. As time passes, each year you earn a percentage of interest not only on your initial capital, but also on the accumulated interest from previous years. In other words, your profits generate more profits. This exponential growth can be even more astonishing in the long run. As the years go by, your money works like an army of financial miners, digging and accumulating more wealth for you. The more you invest in compound interest, the more money you'll have working and generating profit for you. So what does all this mean in practical terms? It means that with compound interest, your money can grow significantly without you having to do much. It's like having a loyal financial partner who works tirelessly for you, 24 hours a day, 7 days a week, generating profits and increasing your net worth. Time is your ally when it comes to investments. And here's why. When you start investing early, you have more decades ahead for your money to grow. With each passing year, your investments have the opportunity to harness the power of compound interest. If you've been enjoying the content so far, I kindly ask you to leave a like on the video. It motivates us more and more to deliver quality content here for you. If you've already left your like, let's continue with the video. But what if you didn't start investing when you were young? Don't worry, there's still time to reap the benefits of investing. The key point here is that it's never too late to start building a more solid financial future. It's true that if you had started investing earlier, you would have had an advantage, but that doesn't mean you should give up on the idea of accumulating wealth. Every day you delay starting your investments is a day lost in terms of growth potential, but don't let that discourage you. The reality is that many people start investing at different stages of their lives and still manage to achieve their financial goals. The most important thing is to take the first step and maintain consistency in your investments. Over time, you'll see how your net worth begins to grow, and you'll be on your way to a more secure and prosperous financial life. So, if you haven't started investing yet, don't wait any longer. Time is valuable, and the sooner you start, the more time you'll have for your investments to grow and secure your financial future. Remember, the best time to start investing was yesterday, but the second best time is today. So, take that first step toward a brighter financial future and start investing today. Your future self will thank you. Now let's talk about debt, which is a financial topic that is often surrounded by confusion and fear. Many people tend to see debt as a monster to be avoided at all costs. However, the truth is that not all debts are equal, and understanding the difference between good debt and bad debt can be the key to making smart financial decisions. Let's start by talking about good debt. This is the debt that can be your ally in building long-term wealth. Good debt is used to invest in something that has the potential to generate value in the long run and ultimately increase your net worth. A classic example of good debt is taking out a mortgage loan to buy a property that you plan to rent out. Imagine this. You acquire a property that generates monthly income in the form of rent. Not only are you covering the mortgage payments with this income, but you're also building an asset that can appreciate over time. As the value of the property increases and you continue to generate income from rent, you're using debt wisely to build wealth. Bad debt, on the other hand, is the type of debt that is typically problematic and can lead to financial difficulties. Bad debt is used to purchase things that do not generate long-term value and instead tend to depreciate over time. Examples of bad debt include impulse purchases, expensive cars you can't afford, or accumulating credit card debt to fund a lifestyle beyond your actual means. The problem with bad debt is that not only does it cost you money in terms of interest and monthly payments, but it can also become an overwhelming financial burden. As you accumulate more bad debt, you find yourself in a perpetual cycle of payments and drift further away from wealth building. The key here is to be mindful of how you use debt in your life. Debt is not inherently good or bad. It's a financial tool that can be either helpful or harmful depending on how it's utilized. So, before taking on debt, ask yourself if that debt is helping you move towards your long-term financial goals, or if it's simply pulling you away from them. Learning to distinguish between good debt and bad debt can be a critical step on the path to stronger financial management and effective wealth building. Do you know what an asset is? An asset is like a very powerful tool that works for you and helps build your wealth over time. It's something you put to work, and as time passes, it generates income or increases your net worth. A classic example of an asset is a property you purchase and then rent out to others. This property not only provides you with monthly income in the form of rent, but also tends to increase in value over time. On the other hand, we have liabilities. Liabilities are like holes in your wallet. They are things that cost money over time and do not contribute to increasing your net worth. A common example of a liability is that trendy cell phone you bought but don't use to generate income. Not only did you spend a large amount of money on its purchase, but it also continues to cost money in terms of maintenance, subscriptions, and depreciation. Essentially, you're losing money every day. When you understand the difference between assets and liabilities, you tend to make more informed decisions instead of spending your money on liabilities that financially drain you. You begin to focus on acquiring and growing assets. This shift in mindset can make an incredible difference in your financial life. Instead of working your whole life to pay off liabilities like debts and excessive spending, you embark on a journey towards building a portfolio of assets that work for you. These assets can include investments in real estate, stocks, businesses, or anything else that has the potential to generate income and increase your wealth over time. So, before making important financial decisions, ask yourself if what you're considering is an asset that will help you grow financially, or a liability that will cost you money over time. By doing so, you'll be on the path to smarter financial management and effective wealth building, bringing you closer to your financial goals and financial freedom. If you're new to our channel, don't miss the chance to subscribe today. I'll see you in the next video.